Yeah, because when you first start, you're doing jobs, money's coming in, you've got money in your bank account. What could go wrong?
Well, a couple of things. First of all, when you get first started, as you say, that you've got the money coming in and so on, but you're not necessarily always aware of the financial implications that you're going to have to cover later. So, for example, your tax bill. Not only have you got a company tax bill, if you're a sole trader, you're going to have your personal tax that has to be paid, and that's going to be paid on every penny of profit you have, which you don't necessarily take into consideration because when you first start, the profit's there. It's your money. You spend it. You forget that you've got to give the government 20% of that because as a sole trader, every bit of profit, you've got to pay 20% to the government because it's personal income. You can, I think it's 12,500 you're allowed to earn now before you pay that tax, start paying that tax. But let's hope you'll be making a lot more money than that. But then there are other things in terms of, you've got insurances to set up, and there's requirements to have payments going out for that. And then maybe, a year into your business and some of your tools break and you need to replace some of your tools, and suddenly you've got a £3,000 bill to cover to get some new tools. You didn't take that into consideration when you first started because all the profit was just going in your pocket and it was being spent. Because you didn't realize that actually there are a lot of financial commitments required to run a business. It's not the same as having a salary package at the end of the week or the end of the month and all the money in it is yours and you can spend it how you want. Because actually the business and running a business has a whole bunch of financial commitments to it that quite often are hidden until maybe a year or even 18 months into the business and you go, oh my God, I didn't realize.